Are you thinking about buying a rental property, or do you currently own a rental portfolio and you're unsure if you own it in the correct structure? So one of the questions we get asked all the time is, how should I own a property, personally or via a limited company? So let's break down the differences. Where you own a property personally, obviously you're going to be subject to income tax on those profits, and depending on your rate of tax, it's going to be at 20, 40 or 45%. Then if you have mortgages on those properties, you'll get a tax credit relief for the interest that you pay, but that's limited to 20%. So higher rate and additional rate taxpayers are missing out on that extra tax relief they used to be able to benefit from. So in comparison to a limited company, the corporation tax rates are between 19 and 25%. And whatever mortgage interest the company now pays, they get 100% tax relief for that expense. So in comparison, it might be that you're better off with a company structure just based on the mortgage interest. However, what you need to be mindful of is mortgages and the interest rate within companies can be higher than personal mortgages. So a full comparison needs to be carried out to evaluate what's going to be better. And equally, depending on the structure and how you've got your properties into a limited company, there might be a double tax charge if you wanted to take that money out of the company personally. So what I'm trying to say is property taxes can be complicated and one structure doesn't fit all. However, this is where our expert advice can come in, because we can help plan for you what your structure needs to be to benefit you now, but also in the longer term, because it might be that a company structure is more beneficial for inheritance tax planning in the future, because that would allow you to pass on these assets easier to the next generation. So get in touch with us if you want some advice and we can assist you.